You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. I got to say, I love that funky tune. Puts me in a funky mood, a mood to sling and talk about some futures options. This is indeed TWIFO, This Week in Futures Options, the program here on the old Options Insider Radio Network, where we break down all of the fascinating activity going on in all the products you don't get to talk about in a lot of our other shows. So crude oil, gold, but also the 10-year and soybeans and maybe some lean hogs. You never know what's going to light it up every particular week, which is what makes the show so fascinating and great for you guys to tune in live. We record it and we stream it, I should say, live every Friday, 3 p.m. Central, 4 p.m. Eastern. If you're around that time, we'd love to have you there in the chat room. You can see the link when we tweet it out via Twitter, indeed, or just get it on the Mixlr app, MIXLR, available on every device on the planet pretty much. And of course, if you're like a lot of our listeners, you listen after the fact. This one's still rolling out to all of the major platforms. It takes a while to get all the approvals in place. So if you're looking for it on iTunes, don't believe it's there yet, though you can get it. The sneak, stealthy way for you guys to get it is, of course, just to subscribe to our main network feed. That's already up there in iTunes and everywhere else. You can get all of our new shows the second they're available. So if you want to make it easy on yourself to get the new shows the second they're out, you don't want to subscribe to individual streams. Subscribe our main network feed. That means everything goes out. It's a lot of content, but it's a lot of good quality options content. If you're checking out that one, then TWIFO has already been up there in the iTunes store for several days now. The new feed coming soon. And in the meantime, of course, you can always find it streaming live every Friday, coming to you via the MixLR app out there. And I am joined, as always, well, first off, I probably should introduce myself. Got so excited by all the exciting activity we have to talk about today. I got distracted, but I, of course, am Mark Longo from theoptionsinsider.com, as well as, of course, from what we like to refer around here, the old Options Insider Radio Network. You can find all of our great content, like I just said, on all those outlets. Also, just head on over to our website, theoptionsinsider.com, and you can get all of the great activity there as well. And of course, you can always grab our mobile app. It's all baked in there as well. So no shortage of ways for you guys to follow along with your favorite shows, download, listen, and occasionally even stream live when we are broadcasting, and check them out there. And I am joined, as always, for every episode of TWIFO by my compatriot, my partner in crime, the man holding down the other hot seat here on This Week in Futures Options, Mr. Nick Howard, the founder and creator of a little thing we like to call around here, Quick Strike. Nick, welcome back to This Week in Futures Options, sir.
Hey, man, good to be back. Hoping we have some good stuff to talk about today. Got some new developments on the weekly report that we can talk about as well, and should be out there and ready for everybody to see in a couple hours, it's my understanding. So worst case, sometime tomorrow. So look forward to getting started again.
Well, let's just do right that then, Nick, because there's a lot of stuff to kick off for us here this week. And as we like to do, it seems like every week, I'm not sure when this is going to change, Nick. I guess we'll have to wait for the activity out there to warrant it. But right now, still the lion's share of the interest, lion's share of the action, lion's share of the questions we're getting from a lot of our audience out there, and the interest and the inquiries, all falling squarely in the realm of crude. In particular, over there on WTI is where we focus a lot of our attention these days. And it's been an interesting week from a WTI perspective. By the way, listeners, we did tweet out the link earlier. I'm going to tweet it out again right now as we speak, listeners. So some live tweeting here so you guys can see, because we talk about a lot of these reports here, and we broke it down on the last episode, of course. For crude oil, there we go, live tweeting as we speak there, listeners. Fascinating radio, there we go. All right, the report has now been tweeted out, so you guys can follow along as you're listening live, or of course after the fact. Those links will be in the show notes. You probably also see them in the notes there in the liner on your device of choice. You can click on the links there, or at least copy it and paste it into your browser so you can follow along. Because we do put these out in PDF format too. We know sometimes you guys can't get to the site, or you can't follow along live, whatever the case may be. So we put these out in a nice, easily digestible PDF format too, so you guys can check these out. Of course, also available over there via Quick Strike, as well as via the portal over there for our friends over there at CME Group. And Nick, you know, what a week it was from a crude perspective. Overall, not lighting it up perhaps as much as it has in weeks past, but there still is that, you know, marked and demonstrable push and pull going on out there in the crude market. It's been happening for some time. For the better part of the last year and a half, the bears were pretty much in charge. Once we got down to these pretty low levels, it became a bit of a song and dance between the bulls and the bears, and we saw a little bit more life in that volatility skew. This week, it seems like the lion's share of the activity was actually centered around pretty much one strike. I'm looking at the report here right now for the week, and you know, overall volume this week about 711, almost 712,000 contracts. Over half of that, nearly 400,000 contracts coming in the, I think they call it active is a bit of an understatement. The June 35 puts over here just lighten it up. A ton of paper, like I said, about 55% of overall volume coming in this one fairly aggressive strike. So perhaps we'll start there, Nick. You know, give us your thoughts on those June puts, just lighten it up, as well as, of course, some of the other takeaways. And again, when you're looking at this report for yourself, we make it pretty easy for you. The nuggets there are highlighted. You can see them kind of jumping off from you on the page right there. So if you're wondering, hey, where are we finding this? I can't find it in the data. It's highlighted for you right there on the page. So it jumps right out to your eyes. So there you go, Nick. Let's dive right in there. Let's start with those 35 puts, and then we'll get the ball rolling from there. What else caught your eye in the land of crude this week?
Yeah, just to clarify, the 35 puts that had the big jump in the June contract from an open interest standpoint, and you know, other than that, we're going to see a lot of activity in these first three contracts. Again, remember June, July, and August. We talked about it last week. How you know, M is June, N is July, and Q is August. We're seeing most of the high activity from a volume perspective was in the 50 strike. So. You know, still some people buying and trying to catch what they think might be a continued rally. But, you know, interestingly enough, now one thing I mentioned earlier when we started to talk is some new things that are going to be available once the report is out. Now, the report's supposed to be out 5 p.m. today. It's supposed to go live now, give or take a couple hours on that, so nobody gets aggravated when they don't see it. But I would expect at some point this weekend for sure, if it's not out by 5 this afternoon, that it'll be available. But what's nice now is, and what I'm doing as well while we're talking, is I can go back, and what we allowed for you to do in the TWIFO report up on the CME Group website is you can go back 2 weeks in time. So, you can think about you can listen about what we talked about, and then you go back and look at the report. So we're not just always keeping it to the front week. We're going to let you go back so we can see what's happening. So even with this continued push up on the crude side, we didn't see any really any kind of bid in the volatility. In fact, over the last 3 weeks, vol is probably down overall. So as much as we're seeing this call buying, we're seeing this steady progression up. We're not seeing this real spike up. So people are still looking, to get ahead of a potential rally, but not a lot of increased volatility either. And if you're looking, and again, the thing that I was stressed to take a look at and keep an eye on, I know we're talking about things in the aggregate here, but a lot of times in these markets, it's not so much that it's one trade that's driving something. It's more of a macro event that's going to dictate whether a price goes up, whether the crude goes up, or whether the soybeans go up or down, that kind of thing. So a lot of our conversation is going to be around sort of these trending things. So here we see lots of 50 calls trading, big volume in that front month. So that's where you want to take care of a lot of your activity. And then open interest change, meaning new players, as Mark mentioned, in that 35 put. So that was the bigger player in the June contract. So a lot of upside call buying. And the other side is, put call ratio on the open interest still generally, pretty flat to, even puts calls in the June and the July contracts. Then we start to get into August, September, October, you start to see more of a bias towards the upside. So, right, in the short term, we're not really sure what's going to happen. Long term, people think we might have a little bit more, there's a little bit more activity in that call side, meaning there's more positions open in that call side. And then we start to get out into the November contract, we see, again, more puts there. So those are the things to watch. And same thing goes for, the put call ratio is not necessarily something that's very common when you're looking at it from a volume standpoint. But what's interesting there is it lets you see for the week where the activity is. So if it's 1, obviously, we have a balance between the put and the call interest. So in that front contract, it looks like there was, as Mark said, sort of a balance between the upside and the downside. People still sort of waiting around to see what's going to happen. And then in those circumstances, you're going to see where, there's not a lot of activity one way or another in the volatility. So it's been off because we sort of went up steady, went up a little bit. So there's not been a lot of interest. So not a lot of price increase. So not a lot of increase in volatility. So we'll have to watch that over the coming days and weeks to see what happens if somebody picks a direction and we start getting the prices pumped.
Now, you're mentioning changes in volatility. One of the things I want to hit on, I know you haven't really released this to the public yet, Nick, and you guys are still working it out behind the scenes, but it is pretty cool stuff. It's very secret behind the scenes numbers. I think you guys, is this the name you're settled on, the QuikSkew? Is that the name you're going to go with? I kind of like that, actually. It's got a bit of a nice little ring to it. But what we're talking about here, listeners, we always talk about volatility skew numbers. We're just talking about these. In fact, you can see these in the TWIFO report every week, the essentially 50 delta risk reversal, 25 delta call, 25 delta put. You can see it across different maturities. And if you look at the TWIFO report this week, you'll see a hefty increase in a lot of those skew numbers, indicating perhaps that's the question though. What does that really indicate? Does that indicate an increase in bid to the puts, like you might assume? Skew usually quoted with the puts over, but again, in the commodities, that could be anyone's guess sometimes. Or does that mean perhaps a decline in the calls, or perhaps a little bit of both, a little bit of column A, a little bit of column B? We'll enter the QuikSkew tool, which I kind of like, Nick. I like that name. I hope you keep it. And it kind of breaks it down in a lot more granularity for you. I'm looking at it right now. Again, this hasn't been released to the public yet, so it's a very secretive thing at the moment, but it is very cool. We'll kind of visually break it down for you listeners, which shows kind of here this same risk reversal, the call wing and the put wing broken down graphically over time, going back years here. And you could see the fluctuations in each portion of that skew. So what happened in the calls are on top, the puts are below, and sometimes they invert and vice versa. And what you can see here is a demonstrable decrease in the call wings, so people not feeling the love for the call wing since our last show, and at the same time a commensurate and stark nearly about 4% or so, looks like increase there for some love for the put thing. And combine that across the maturities, and of course, it changes the more steep, more stark in the near term because that front month is kind of all over the place and it moves around very rapidly. A little bit less so as you go farther out the curve, but still interesting to watch, Nick, this kind of push and pull. And the skew really tells a lot of the tale out here in WTI. It's why I keep bringing it up, because that really tells you the tale of what the market is thinking, who's winning that tug of war right now between the bulls, between the bears. I think the skew is the best place to look. You see a lot of people talking about other things and other fundamental reports for crude and supplies and histories and all these other fundamental factors about what's going to push and pull the product. But I think it's all told right there in the skew if you learn how to break it down, which is why I think this tool is pretty cool. So first off, A, are you going to stick with that? And then B, walk our listeners through some of the other things you're looking at, because you've been playing around with this tool a lot longer than I have.
Yeah, so we're probably going to stick with the QuikSkew, and we any kind of special number that we come up with on our own, we're gonna try to brand with the Quick Strike name. So QuikSkew is probably going to stick. So did you tweet this out? So are people seeing this? People can see this chart?
No one is seeing it yet. As I said, it's
okay,
secret.
Not seeing it yet.
It's secret
so
behind the scenes.
Basically, the idea behind it is supportive. Is really. It's really a percent change in the percent volatility. So you're not really looking at a raw percent change in volatility. And it was done that way. So, 2% when something's 20 vol is much different than 2% when something's 100 vol, right? So the idea was to, make it volatility level agnostic. Okay. And then it was also meant to give you an idea of, whether the puts were expensive. When you have a 25 delta call and a 25 delta put, that vega, or that amount that volatility is going to affect that option, those numbers are numerically the same, but they could very well have a different volatility. So when your put skew, when the put volatility is high in comparison to the at the money, that is a more expensive 25 delta put than if it's below the at the money. So this chart is meant to show you where the rich and cheap vega or volatility is. If you want to buy options, it's telling you which one's cheap, which one's rich. And it's also telling you how they compare to each other, whether they're close to each other or whether they're from a percent over the at the money standpoint, or whether they're far from each other, meaning there's a big tilt in the volatility curve. And it also lets you start to think about, hey, I want to buy volatility, so which strikes am I, if volatility's low, which strikes make sense? Or I want to put a spread on, so which strike is worth owning versus the one selling. So that's really the idea behind this. And when this does become available, you'll be able to really get a pretty good idea of how often the call and put skew flips. You'll be able to look at this chart historically and tell what the vol skew curve looks like. Is it a flat curve? Is it a parabola curve? Is it like a slide, a water slide at the park? And then you'll know if it's a water slide from the call side down or the put side down. And it gives you historically and at a glance where things are currently, where they've been, and how they fluctuate over time. So really, the idea behind this, and you see it, when you start, if you go look at the soybeans of this chart, you'll see that the calls and puts flip back and forth. One is over at the money, the other one's below. Then one will come below, and the other one will be over. So it really allows you to start thinking of ways that you can trade this market. What are some of the trends that occur here? And the same thing happens in the treasuries as well. So that's sort of it's a quick skew, right? A quick look at the skew, and not just call. If you take a call minus a put and you see that the calls are bid over the puts, that doesn't tell you anything about the relationship to the at the money either. And you need the butterfly for that, which is a different story we could talk about some other time. But even the butterfly doesn't tell you whether the call is super expensive in comparison to the put, and they flatten each other out. So for me, I'm excited about it because I think it's going to give people a quick glance at what things have done historically, how they look in comparison today, and how often there might be some trade activity or some trades that you could put on and really take advantage of what's going on in that market.
Well, let's switch gears now to another market that's been top of mind for a lot of people these days. That is, of course, the shiny stuff. Not silver, but gold. Looking at the gold, the TWIFO report for gold right now. And again, you can get all these PDFs as well. We tweet them out for you. Going to put them in the show notes so you guys can follow along. Or if you're QuikStrike users, you're logged in there, you can log in and see this stuff live for yourself. And Nick, it looks like kind of a similar story in gold from at least a congregation of volume perspective, we were talking about how those puts were really lighting it up out there in WTI over the course of the past week. A similar story, not so much puts but calls, but still kind of dominating the market out here in the big gold options. It was indeed, looks like the June 1300s really just dominating again. Over half of overall volume this week coming in that one strike and that one particular option. Over about 100, close to 175,000 contracts total going up this week. Nearly 97,000 just in those 1,300 calls. So kind of interesting. I guess when the volume tightens up a little bit, it tends to congregate and aggregate in one particular area out here, at least in both of these main products that we were talking about here as well. Also a similar story from a skew perspective, with the skew getting a little bit bid up out here. Our old 50 Delta risk reversal pretty much across the board all the way out into 2017, catching a bid. I'll have to pull up the QuikSkew to see exactly where that's coming from, if it's from the puts or from the calls or a combo of both. But still interesting stuff here across the board. So, Nick, what else is catching your eye here from the TWIFO report for gold this week, sir?
As far as the skew goes, it looks like we have a little bit of a divergence. So the calls are bid and the puts are offered a little bit in comparison to the at the money. So we're seeing a little bit of a separation or a tilting of the curve from where the slide coming down from the calls going down toward the puts. So that's where we're getting a change in the skew there. So a decrease in one and an increase in another. And again, like you mentioned, more upside calling really towards where we're rallying, much like we're seeing in the crude. Went back while you were given the fill into this. Over the course of April or the last 3 weeks, we haven't seen much activity or much increase from a volatility standpoint. So prior to this week, we really were, we started out the two weeks prior with no real bid in volatility, even with the move up in gold, and now this bigger rally has finally given us some bid to the volatility. Now, I know one thing we want to start looking out for on the show is sort of activity or odd activity in strikes that are out there to keep an eye on and say, well, why is something happening way out there or way up there? So two things that you're not, or two expirations you're not going to see on the current report that was sent out. Now, right now, just so you understand, when you do go to the reports, in the display settings, there's going to be a cutoff, a DTE or a days to expiration cutoff. And right now we defaulted to 1 year. So typically, because that's where most of the activity is taking place. But I have another sort of detailed report, and you can go and change it to 2 years, 3 years, or show all. So you can get a report for all of the options that we have in the system. We don't always show every expiration because the real far out ones don't have much open interest. But typically it's 2 or 3 years on something like gold. But in the December of 2017 and the June 2017, we had some buyers in the 1850 strike. So that strike opened this week, 2,500 calls traded on the DEES 1850 strike. And then in the June strike, we had a big increase, about the same in open interest for the 1,600. So there were some players out on the term structure that were buying some upside. So, if I'm looking at this just from a general sort of activity standpoint, nothing tremendously exciting, other than, a good amount of volume for that contract. There was an increase in open interest, means that there were some new position takers, right? We didn't see much change in the put call ratio, so that means no real bias change was in terms of people thought things were going up or down. And again, remember, one means even puts to calls in terms of open interest. Higher than one means more interest in puts, right, et cetera. So you can go from there. And same, and really when it comes to the buyers, the buyer in the volume side, you get probably more call interest, as Mark mentioned. So I would probably categorize this as not, outside of the fact that we had a huge rally in the future. You don't see really a tremendous amount of activity per se in the options, or at least in my opinion, it doesn't seem like there's that much that was really happening from a super interesting standpoint. Other than the fact that it looks like people were speculating on a little bit more rally here. But that's about what we see for the gold.
Yeah, gold and crude kind of congregating in one particular strike, or one particular area of action. We'll turn our attention. Another one has kind of been popping up on our radar a lot here on the show lately, Nick. Not one we talk about on the broad network that often, so I'm glad we get to bring it up here. It's the beans. The beans have kind of been rocking and rolling. Good old soybeans back on our radar today. We just tweeted out the reports for you guys. Again, if you want to read them after the fact, you can get them in the show notes there. We'll leave these PDFs obviously unchanged so you guys can see after the fact, days, weeks, months down the road. You listen to this show, you say, hey, what exactly were they talking about on that particular strike or that month or whatever the product may be? You can get those PDFs and you can check them out. Obviously, the live version on the website going to update continuously. So go for the PDFs if you want the exact freeze frame, what we were talking about here on the show today. And it looks like another, fairly, a lot of the products weren't lighting it up that much. Fairly decent week overall for the old beans this week again here, Nick. And again, looks like not as much of a concentration of liquidity, not over half. Instead, about a third or so of the overall volume. We saw nearly 620,000 contracts out there, about 210 of that coming in a fairly aggressive. I believe these are the July 960 puts. Yes, looks like that's 960. I should blow that up on my screen a little bit, make that a little easier to see. There 960 puts, lighting it up to the tune of, again, about over a third of overall paper coming in as one strike, about 210,000 contracts. And again, a similar, perhaps even more pronounced change out here from a skew perspective, looking at the overall 50 delta risk reversal, or as you listed here in your old school terminology, Nick, your 25 delta risk reversal, you old school CME guys. You talk options so weird, but yeah, looking at that from a skew perspective, the put's getting quite a bit out here with about 3 handles and up more in some of these farther off months, and pretty strong across the board, indicating that there has indeed been some rocking and rolling out here over the past week, Mr. Nick. So let's start there. A lot to break down here in the realm of the beans. What's catching your eye in particular out here, sir?
Okay, so first, just to clarify, I mean, because again, everybody calls these things different, right? We call them risk reversals, combos, squashes. We had all those names in the Eurodollar pit.
Squashes, so good God, sir.
Squash, right? Squash, because you turn one leg one way, one leg the other. So it's like you were, wringing out a sponge or something like that. Risk reversal, right? Whatever you want to say. So we always do calls minus puts. That's how we do it. So when you see a positive number, that means calls are going to be bid here. Now, as Mark's been saying, one advantage we have when we look at the QuikSkew report is we can tell whether it's a divergence in the call and put volatility, whether it's one getting cheaper, one getting richer, whether it's both getting, and if there's no change, whether it's both getting cheaper at the same pace, moving towards the at the money. So in this case, what we have is again, a divergence. The calls are getting bid, and on the 3-month area, and the puts are getting offered in the half year, the 6-month area. And then on the shorter dated 30-day option, which is really sort of the generic short-term expiration that people talk about, here we're seeing they really move toward each other a little bit with the call staying a little bit more firm than the puts. And you can see, even though we had an increase in the skew, meaning the calls got bid, the larger activity, at least from an individual strike standpoint, was showing to be in the on the put side and the most active on the volume for the week. But when we look at an open interest change across the board, at least Monday through Thursday, we're seeing a tremendous amount of activity in the upside calls, ranging from in the July, August, in the November. And again, this is on a report that you can already get for free. This is the open interest most active report that's already available for free on the CME Group website. So I sort of use that as a supplement to these one-line summaries. You can go there and take a look and get very detailed information about individual expirations and strikes within that expiration. So again, you see on the rally, people, a lot of activity in strikes. It could be, again, a number of reasons in the puts. People could be getting out. People could be saying, okay, this can't last. People might start looking at the long-term trend of where the beans are. Some of the news might be coming out being a little bit more bearish, even though there's a continued rally here still for this week. And then overall, again, the most important thing here, and again, for people that are just starting to look at the futures options, huge jump in open interest, 125,000 change in open interest. There's liquidity there, and it's in active months, and it's available across multiple months. So start paying attention, start watching what's going on in these markets, start looking at the skew, looking at the put call ratios, seeing what big strikes are changing and trading across the different months. And I think you find yourself some opportunity to start participating in the commodity market.
Yeah, speaking of big changes in OI, also saw a similar big change out there in the land of the 10-year. The 10-year putting on over 500,000 contracts this week from an open interest perspective, or about a third an increase out there in open interest. So people who are out there, wringing their hands saying they can't find volatility, can't find volume in some of the traditional equity index options they may be looking at. This week, notwithstanding, earnings and some other things have injected some vol and some life back into the market. But in the last couple of weeks and months, we've been hearing some of that refrain. There's no vols, no volume. Well, looking out into the commodities may indeed change that opinion. We're kind of running up against it here, but we're seeing a little bit of a concentration of activity here in the 10 years as well, Nick, with looks like these 133 calls really dominating the board. It might be the highest peg we had of all the products we talked about on the show so far, with 61% of the volume coming on just these 133s out there in June. So yeah, lighten it up quite a bit. We're coming up against it, so I'll let you run with this. Then we'll dive into some quick futures feedback here on our second episode. So have at it, sir. Break down the TWIFO 10-year report. Then we'll see what our listeners have to say.
Yeah, really what you're seeing, a lot of upside call buying this week in the treasuries. And ironically, Mark and I were talking about before the show, there was a lot of covered call activity early in the week or the last few days where Strike was bidding covered against futures, same futures price, but higher price in premium. So that means there was a bid in that volatility for that particular option. But what we saw here is that overall, even though there was that upside buying, there was not a real increase in the volatility across the board. Now, we did see a change in the risk reversal, which means, and in some cases, we saw a flip on the shorter dated ones from a put bias to a call bias. So that call buying really represented the fact that there was a bid in the call. So you saw that happen in the risk reversal. And then as far as the put call ratio goes, from a volume standpoint, you definitely see that calls were more in vogue than the puts were. So lots of call buying in the treasuries. There was a sort of a neutral stance in the FOMC meeting with a nod towards a potential tightening coming in June. But at the same time, for that 3-month period, people are still looking for maybe some upside here in the treasury market.
Good stuff, Nick, and we are coming up against it, but it's only our second show, Nick. We're already getting some feedback from the listeners. So without further ado, let's give them some time on the show here as well with some futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, welcome to the Futures Options Feedback again. It's only our second legit real show, third if you count the sneak preview. Already getting some of you guys writing in, which is always fun to see. In fact, the show's not even live on most of the major platforms you guys are probably used to getting it on right now, so good to see you guys sneaking in. A lot of people writing in after that first show, Nick, saying they enjoyed it, they want to hear more, so that's a good sign. I just pulled one here from one of our frequent commenters, Mark Brandt, saying, hey, congrats on the new show. I enjoyed the preview, looking forward to the weekly shows. I love selling futures options premium. So there you go, getting some love. And hopefully we're giving him some ideas as we're highlighting some of these products, Mark or Nick, that are really rocking and rolling right now. Some products that are exhibiting some volatility, some changes in skew, certainly attractive from a premium selling perspective. I think we got time for one more here. This is actually not a quick one. It's an interesting one, though. It shows where our audience, sometimes they think of interesting stuff, Nick, and they come at questions from a different perspective. This one comes from John King writing in saying, hey, he retweeted an article to us from Bloomberg. Want to know our thoughts on this. He said, hey, do you think the option markets over there could suffer from this as well? He's referring to China and to an article from Bloomberg a couple of days ago. It said a life expectancy under 4 hours shows a China commodity frenzy. It's an interesting article, listeners. I encourage you guys to check it out. And it kind of breaks down a lot of interesting things and just showing, and particularly in the commodities area over there in China, the intensity of the speculation is pretty strong, particularly coming from a lot of the marketplace out there. A lot of areas like iron ore futures. Goldman coming out with some concerned notes recently, saying that the daily volumes out there in iron ore are now so large they sometimes exceed the annual imports of the product. Again, kind of interesting from a turnover perspective. They're saying also some analysts from some of these futures companies out there that track these products, saying much of 70% of the trading in Chinese iron ore and steel ore, it's on the futures, not as much on the option side, though I'm sure it's commensurate if they do offer it, is retail investors speculating on these price movements. Looking at the aggregate duration of these trades, too, is kind of interesting. How long the lifespan, effectively, of how long these trades last. Iron ore, steel, rebar on the Shanghai Futures Exchange, their average duration is under 4 hours. So very, very short, very, very high turnover. By way of comparison, something like WTI over there at CME is about 40 hours. Nat gas about 70 hours. So those products have a little bit longer lifespan there. So again, this kind of feeds back into something we were hearing about a year and a half ago when China was first starting to look at listing some equity options. There was a lot of concern from the government there that there's a speculative nature to that culture over there. They like to gamble. That's what they like to do. And so there was a lot of concern that would translate into what the retail was trading. And there was a lot of concern from the government. They wanted to put in very large multipliers to try to keep retail almost at bay from using these products. And now those products have started, and they have some index options over there. They haven't done a ton of volume yet, but they're getting a little bit more active. But now we're seeing, at least on the commodity side, on the futures, which is interesting, not often a retail-friendly product, those are really just catching a lot of attention from the retail populace. You know, some of this, Nick, can also be kind of attributed back. We see this sometimes with some of these hot products. A lot of people kind of, shaking their heads at what they call excessive speculation. I'm not going to get into that, the role of speculators versus market makers and things like that. But there is an interesting note to be had here about the participation of retail in these products and what that does indeed mean for perhaps the future of options, futures options, equity options, whatever, over there in China. Because if these numbers are indeed correct, and as Bloomberg is citing them, they sound right. I'll have to dig into them a little bit more. That probably will cause a lot of the regulators over there to take a second look at listing new products and new things. A lot of people who are hoping that this may be the era of ushering in a lot of new options products and volume and paper over there in China. These numbers may give the regulators over there a bit of pause and have them pump the brakes perhaps even more aggressively than they've even seen with some of the new products they're listing there already. So I don't know. I'm curious, Nick, what are your thoughts here? Again, this doesn't just mention futures options. It's mostly on the futures side, but still interesting, and our listeners want to know what your thoughts are on this as well.
Well, I think what you're going to see here is, there's two things. So I recently learned that a lot of the trade that does happen, not all of it, but a lot of the trade that does happen in Asia is based on handheld devices, because everybody has a handheld device. So that would give just a vast majority of people opportunity to trade more easily, right? So not everybody's sitting at their computer doing things. If they could do it right from their handheld, that might be a reason for such a diverse volume set and such activity in and out of the contracts themselves. As far as it affecting whether options are going to be able to trade over there, I know there's an exchange that started over there. I think you say it Nanhua, Nanhua. It's the first Chinese-owned NFA-approved full clearing member, and they clear CME Group products. Okay, and they're just opening up branches all over mainland China that are going to offer these services to clear CME Group products, futures and options, to large network of high net worth clients and stuff like that. So I don't necessarily. First of all, the exchanges are never going to be upset that there's a lot of volume on something. And regardless of what the life of that is, I think they're always going to be happy. And the whole idea, the exchanges are, the futures exchanges are starting to promote themselves as options exchanges too. So as much as it might be scary from a speculation standpoint, I think, the push from the business side of things are to open up and to make these options products available to that part of the world, clearly because high population, lots of trading, easy to trade, mobile technology, and means lots of volume, means lots of clearing fees. So I don't think there's going to be too much of a concern. Maybe they'll put some throttles by increasing the multiplier, but then people will back off on their size and the trade might still exist the same. But I still think that you're going to see a huge growth in this market. And when they start to get their hands on the CME based products and start to learn more about them. That's really the next step is for them. And I know this exchange as well is looking to educate them. There's a Chicago Institute of Investment that's around that is trying to train institutional retail customers, mainly, around China, and then they're bringing Chinese here to teach them as well. So there's a big push. That's the huge push, is to get it out in that part of the world.
All right, Nick, that music means we're coming up against it here on another episode of TWIFO. We went a little long, but it's always fun talking futures options with you here, Nick, and of course getting to see what you guys, the listeners, have to say about these topics. You have questions, you have comments. We love to hear from you guys. The easiest way, of course, hit us up via social media or via the chat room here. If you are able to tune in live, I know a lot of you can't, so tune in after the fact. This show should be available on pretty much every podcast outlet by the time you hear this next week, hopefully. So all the major stores, iTunes, Google Play, TuneIn, Stitcher, etc. It's already there right now if you subscribe to our main network feed, so grab that if you haven't already. You get all of our shows anyway. It's a great way to just mainline all of our content. If you just want TWIFO, you got to wait a little bit till that feed gets approved and launched in all the stores. That should be soon, if not by the time you hear this program already. And before we go really quickly, Nick, we've been talking about a lot of cool things at QuikStrike. Where should our listeners go? What should they do if they want to check out more of this stuff for themselves?
Well, I always recommend everybody to look at the free stuff first, because that's kind of the best introduction to what's available and readily available without much effort. So if you go to cmegroup.com and search for QuikStrike, QuikStrike, or go to the options page, you'll see a list of all of the tools that are available out there, as well as QuikStrike Essentials, which is a free version of QuikStrike, which has end-of-day information, open interest settlements, pricing sheets, some trade examples, some education, volatility curves, and vol term structures as well. And then recently, just released this Monday, you can, if you download the iPhone CME app, all of our tools are now available as a tab on that app, so you can get all of the open interest, vol term structures, pace of the roll, vol to vol tools, everything, all out there. So start at the CME Group website, and you can always find us at QuikStrike.net, QuikStrike.net. Thanks very much, Mark. Appreciate it.
No problem, Nick. Well done. You just paste in there with the music. It's like you've done this before or something. So that is going to do it for this episode of TWIFO, This Week in Futures Options. Again, look for it wherever you find your favorite Options Insider Radio programs. Coming soon, hopefully. You can join us every week live. Looks like 3 p.m. Central is the time we're going to be doing it. So check us out there if you can. And on behalf of Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, for sending in such great questions. Keep them coming. And, of course, for tuning in live. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.